Hey, what's going on, guys? Cody Sell here. We're going to be looking at stop losses in this video. This is a very important topic. As you guys know, from day one, we have recommended using stop losses. There are a lot of traders out there who don't use stop losses because they rationalize that it causes them to be taken out of trades because people are coming to get them. And the people who use that reasoning, A, they're mostly novices. B, they're not consistently profitable traders. There's no way. C, they don't understand market manipulation. And D, they don't understand how to properly use stop losses, okay? And basically, the first thing I'm trying to get out here to you guys is you need to always put a stop loss. Okay, if you can't limit how much of your account is at risk for a given trade, you cannot trade, all right? So I'm just getting out there right off the bat. You need to use stop losses. Now, let's talk about what is the purpose of a stop loss, because I think this is the part that really separates these guys who are having these issues out. And it's because they think that a stop loss should be designed to take you out of a trade at an optimal time. Okay, and that's really where the problem's coming in, because guys, a stop loss should not be used to give you an optimal exit from a bad trade. All right, a stop loss should be placed to protect your account should price find a lot of volatility, liquidity, and go against you. All right, it's not really designed to give you a good exit. In fact, if you use a stop loss appropriately, it's a really bad exit. Okay, and I'm going to show you guys what I'm talking about. So let's take a look here, and let's look at a hypothetical trade situation. Let's look at maybe a couple of them here. So let's put this right here, and let's say that we came up and maybe we had a zone here, and we took a sell. Make it red. Get this off my screen. Let's say that we entered a sell trade when price came back up into this zone. Okay, just hypothetical situation. And the targets don't matter, right? But in terms of this stop loss up here, a lot of guys who are new or don't understand how to properly use their stops will put their stop loss right here above this zone. And the rationale for that is, well, if price breaches this zone and comes up into this area, I don't want to be in the trade anymore. Okay, and that's fine, but the problem is that you need to be able to have more flexibility than that, right? Because obviously, look what happened. Price gave a little wick, came back down. Do you really not want to be in the sell trade anymore just because of that? Obviously, no, right? Price held. There's no reason to exit this trade. And so that's going to be where the separation occurs. And everyone who put their stops right above the zone is going to get taken out. Why are they going to get taken out? Well, either A, it might be just a small fluctuation that was enough to take them out, or B, it might be because this was a push by an institution to take out stop losses, because that happens a lot. Regardless, it's only taking out the retail traders, right? The people who don't really know what they're doing. The correct placement, guys, for a stop loss in this case is something up here, way up here, out of the way. Nowhere near where it should actually be triggered. Guys, if your stop loss gets triggered, it should be a rare event. What I'm saying, guys, is that you need to be prepared to exit your trades manually when possible, right? And I know that some people have work and they have families, and guys, if that's the case, you need to trade the higher time frames, or you need to trade the very low time frames, where you can either A, block off 4 hours a day to trade and get a lot of trade opportunities in by trading the 5-minute, or B, trade the 4-hour daily chart where you can check once, twice a day and manage your trades. Because guys, you need to be prepared to exit manually. So what would that look like? Let's say price gave you a green candlestick that closed on the other side of this zone. You would then close your trade manually right here, minus 35 pips. You do not, however, want this green candle to hit your stop loss. This should not hit a stop loss. Your stop loss should be up here to protect you from something like this that might come in at maybe an NFP news event or whatever it might be, right? You don't want to be in a trade if something like that happens. But guys, your stop loss is for protection only. All right. let's look at another example. Let's say we took a sell trade again, same setup right here. Right here, we just entered the sell trade, right? People will tend to put their stops right in here. And in this case, yeah, price stops it out, and they might think, okay, that's a fair exit. But in reality, they shouldn't have been stopped out. Their stop should have been up here. They should have manually exited at the close of that green candle. Okay, and the crazy thing is, guys, is people think that by putting their stops really close like this, they're really giving themselves, you know, great exits if price continues on. And guys, honestly, most of the time, if you close manually, you get a much smaller loss, right? So like, let's say in this case, if the stop loss was like up here, right, and it gets hit, but notice how when the candle closes, it comes back down like 50%. So that's half the stop, guys. You know, so that's those are just examples, and there are a lot of examples, guys. Look right here. Let's see you sell at this resistance. Very simple trade setup. So I'm just trying to give you guys an idea. Anyone who puts their stop loss just above is going to get taken out, right? Stop needs to be up here. What is this to protect you from, right? Guys, right here. This is what a stop loss is meant to protect you from. You might take a buy. Let's say you go long right here. Your stop loss is down here as a protection against giant red candles. And in this case, you know, obviously price shot right back up. But oftentimes when that happens, price continues on for a major reversal. And let me see. Oh, I know a great example, actually. Let me pull up Euro USD. Euro USD likes to kill retail traders. Get rid of all this. Duplicate that. I'm going to leave that because I have that marked up for some guys in the group right now. And let me clear all this off. So let's take a look at this, right? Let's say that we're in this downtrend here, and we buy this breakout candle, okay? You buy the breakout candle, and you're going for up here, right? Now, let me go down to the 4. All right, so let's take a look at this. So what's going to happen when you buy that breakout candle? What most people are going to do with their stops is they're going to place their stops just beneath the low. That makes right about there, right? That makes sense, right? Because price shouldn't breach the low if it's going to go bullish. And while that may be correct, what they're saying makes total sense, and you guys know that because you've gone through the training. But what doesn't make sense is putting a stop loss right there. Because guys, price is going to wick through. I mean, it happens almost every time. In fact, if you guys want to see how consistently price is going to come and try and take out your stop losses, it doesn't take me going to another zone. I can show you right here. Here's your sell trade right here. Boom, there's your stop hunt. Here's your sell trade right here. You got a double top formation, flag formation, counter trend line lower, however you want to look at it. Boom, price flies through, takes you out. Right over here, guys, look at this. Right here, you take a sell trade up here, wicks through, takes you out. Guys, literally, if you look at every single reversal spot in the market, price comes back through to take you out, right? It breached the wick there. It breached these low. Look, guys, price held here, okay? It just came to take you out. Almost every major reversal area in the market, look at these wicks that came through, right? Originally, if you sold, stop loss just above, it's going to come get you, okay? The reversal spots in the market, guys, they are designed to take out retail trader stop losses. Look at this. Look at this, guys. Stop losses were all put just above just to take people out and piss them off. But the problem is that people don't know how to use stops, which is why it gets them, okay? And I encourage you to go through and look for yourself. But guys, stop losses, it's a very simple concept that I'm dragging out because it's so often misunderstood. Stop losses are to protect your account. They are not to exit your trades when you are wrong. When you are wrong, you need to exit your trade manually based on whatever criteria you have set for the trade. If you enter a trade based on a trend line breach, you need to exit the trade if price comes back within your trend line. If you enter a trade based on a support and resistance breach, you need to exit the trade if price comes back through your support and resistance. If you enter a trade based on structure breach, you need to exit your trade if structure breaches the other way, right? It's a fairly simple concept, but guys, it makes such a huge difference in your trade success. So I hope that you implement this in your trading. I'll see you guys next time.